Hello everyone and welcome to the second of our finance webinars developed as part of the Money Matters series. My name is Aileen Deasy, Manager on the Enterprise Development team, and we are delighted to bring you this really important finance webinar today. So thanks a million for taking the time, and great to see a lot of businesses taking part in this today. So this is a really important area for all businesses as we move from survival to recovery. We are acutely aware of the challenges that you've been facing with rising costs and the impact of all of this on the bottom line of your business. So therefore, to help you navigate the current financial environment, this webinar is focusing specifically on managing your cash flow and repairing the balance sheet. So we're absolutely delighted to be joined by our two experts today from Crowe. So we have Maria Doyle-Balfe. So Maria is Director of Hotel Tourism Leisure in Crowe and has over 20 years experience in industry and consulting experience in the hotel sector, also in tourism and leisure industry. She has held senior management positions in the hotel sector and the tourism sector, and has an in-depth knowledge of this sector, both operationally and financially. Aidan then is a partner with Crowe, working in the corporate finance department. He is a fellow of Chartered Accountants Ireland and a member of the Representative Committee of Restructuring and Insolvency Ireland. So Aidan's expertise is particular in relation to debt financing, business liquidity, cash flow management, capital appraisal decisions, and strategic business planning. So we're in good hands to talk about this very important area today, and I'll hand over to you now, Maria.
Thank you, Aileen, and hello everyone. So we thought today what we would do is we'd go through a number of areas, just a couple of topics, I suppose. First of all, market overview. Just to give context, I think really to where we are, like it's important for all businesses to look at the external environment. So really just to chat through that a little bit. And then what's the implication of that on the business, on the attraction business. So looking at the implication of scale of operations, so looking internally, what are the visitor attractions like in Ireland as a group, I suppose. And then what we're going to do is take through a scenario of what a P&L looked like, moving on to the balance sheet and then cash flow. So 2019 and really then looking forward to how the impact of COVID from a balance sheet perspective is going to impact our cash flow. And then we'll talk about cash flow and really what's next for the sector. So I think we'll go straight into it and we will look at the market overview. So Aidan, here we have four areas that you and I have discussed really and how they impact the sector, looking from an external perspective.
Yes, I think in terms of on post-pandemic economic recovery, now the travel restrictions are more or less gone completely. We're looking at like a strong rebound here. But I think what most of our listeners will be concerned about is what does recovery mean, I suppose, for my business? What does recovery mean in terms of revenues, and what does recovery mean in terms of costs? And they'll recognize that we're in a very different world than we were in 2019. And you know, that's very much so the costs and our cost base are higher, and therefore that's impacting our profit margins and our profit levels. And I guess really, I suppose it's the supply chain disruptions that's feeding into that. When we think of supply chain, it's not just goods, it's very often, I suppose, services. And maybe to call out, I suppose, just three in terms of labor costs for most of our attractions businesses, that's a very high part of our overhead. We know that when we were closed, we lost some of our people to other sectors. We know that some of our people have gone to their home countries, and therefore rebuilding teams is a challenge. That in itself is impeding, I suppose, getting revenues back to 2019 levels. On the energy front, you know, we're seeing energy costs up maybe 30% in 2021 and maybe up to something similar in 2022. So these costs are increasing at a far higher rate than our revenues or our prices can increase, and therefore will eat, I suppose, into profit. Also on the insurance cost, another overhead, what we're finding is, you know, there's very limited appetite from the underwriters for anything to do with leisure, and therefore there's a limited, I suppose, appetite for writing this business, and we're often becoming, I suppose, price takers. So we're seeing significant jumps in premiums year on year, and I suppose that's a cost that seems to be difficult, I suppose, to manage, or difficult, I suppose, to get something that's competitive or in line with what we were paying in 2019. Ukraine, I suppose, Russia war is very much about energy, and energy costs, while they were high in 2021, it looks that if we're taking, I suppose, a supplier of energy in terms of 10% of gas and oil out of the supply side of the equation, it'll take a number of years for that supply to be replaced, and therefore we're looking at high energy costs over a number of years. And it's not just, I suppose, the light and heat within our attractions. All costs, I suppose, are impacted in some way by oil, in terms of whether it's transport or whether it's food through the restaurants in terms of fertilizers. And that very much, I suppose, feeds through on sustainability, because these higher costs are not just for businesses, they're also for our customers. In their daily lives, they're looking to reduce the costs, in terms of energy costs, whether it's travel or whether it's in their homes. And I think that's going to put a greater awareness on sustainability, and they'll expect, I suppose, the outlets that they're dealing with to also have, I suppose, the same focus and the same awareness in terms of energy conservation. So that much will also feed into how we reinvest in our attractions, and looking at the funds we have for reinvestment. Will the choice be over some maybe guest amenity, maybe new carpet or new tiling, versus, I suppose, something that might be on the sustainability side, such as solar panels, that will lead to a cost saving and show, I suppose, our intent, I suppose, to reduce our energy consumption.
Thanks, Aidan. There's a lot there, actually, and not all positive, I suppose. Really challenging for the sector. But let's look at demand, I suppose, and how that's going to fare out. Domestic tourism has been really good for attractions and for the country as a whole over the past 2 years in particular. What are your thoughts on, what the projections forward, or what domestic trips will be like in this year and maybe the next couple of years?
Yeah, I think in terms of, we are very much at, full employment. We've heard of the savings, I suppose, that people have built up during the COVID period. And therefore, I think, there is, and I can see it myself, I suppose now that we have a sense of freedom, we want to catch up on trips that we haven't taken, and we want to catch up on activities that we haven't been undertaking over the next kind of year, 2 years. So therefore, I think 2022, I think, will be a strong year in terms of demand. But as I said earlier, businesses are looking to get back to 2019 levels. And if they're looking to get back at 2019 levels, I suppose we look at the trips for 2019. And on this graph here, we can see in quarters 1 to quarter 3, there were 9 million trips in terms of domestic trips in that year. We can look at the fall off in 2020 and 2021. Especially over the summer of 2021, is quite noticeable, why that 6.6 has reduced to 4.1. So while I think there's going to be a strong rebound, I think getting back to 9 million domestic trips, and these trips are obviously very important in terms of bringing people to the areas where the attractions are.
So do you think, I suppose, let's look at the international, do you think that there will be a replacement maybe of what we lose this year by international guests? Like we can see a long-term trend here in this slide.
Yes, we can see, I suppose, that anytime we've had a setback, we've come back stronger in terms of international visitors, and I think that will happen over the course of time. So the question is, how quickly will it come back over the next 2 years, next 3 years? And I think the piece of work that was done by ITIC, showing 3 scenarios, I think is informative here. So in red, I suppose we have their negative, I suppose, scenario. In, I suppose, the mid-green, we have their base case, and the darker color on the slide, we're looking at their positive case. So what we're seeing, I suppose, so far this year is arrivals are tracking about 35% down on 2019 levels. which would be 6.3 million for 2022 if that continued, and therefore we could be ahead of the base case, but still that's telling us that we're not back to 2019 levels till 2025.
Thanks, Aidan. I think as well what you're telling us then is, looking at the external environment, looking at demand or supply chain issues or costs, that we really need to focus on forecasting and budgeting and taking those impacts into consideration and how long they're going to be. So if we are expecting utilities, the increased costs for several years, then we need to kind of look at that now. So I suppose moving on and looking at the scale of operation, looking at internally, what is the visitor attraction market look like in Ireland? And you have a slide here about the trading market overview by visitor numbers. So you've categorized visitor attractions by the number of visitors that they get on an annual basis. And what does this tell us?
I suppose when I look at, the overall list, and I look at, the number of attractions that have visitor numbers being up to 40,000 visitors per annum, I'm seeing, very high levels of attractions. So 2/3 of the attractions have fewer than 40,000 visitors. And what that tells to me is at that level, it's very hard to achieve economies of scale. So they're businesses that have high cost bases. A lot of them will have high cost bases, and therefore, a business with a higher cost base and costs increasing very quickly, it erodes, their profit and their profit margin. So I think those businesses need to look and see, well, what costs are coming through in 2021, and those costs could be very different from what were in the business in 2019.
So I think that's that's interesting that we're going to look at that. So here's a slide, I suppose, of the implications of these rising costs. So if a typical visitor attraction, like what they looked like, I should say, before COVID as opposed to post COVID, what is the challenge for one of those visitor attractions?
Yeah, and I think what we do here is two scenarios. One scenario where the attraction is having, an EBITDA percentage of 16%, so it's got high overheads. And the second one, is a business with lower overheads, where the EBITDA percentage is 40%. It's a larger business. So taking the first scenario, what we're looking at is pre-COVID, that business would have had a turnover of 500,000. Its costs were 420,000. Its EBITDA was 80,000, and its EBITDA percentage was 16%. And I suppose the other way of looking at EBITDA percentage is that its cost base is 84%. So in the next scenario, we're looking at, well, how far back in terms of revenues are we getting to 2019 levels, and looking at, reduced, domestic trips and reduced international visitors coming in. We're a year or two away from that. So if we achieve 450,000 in revenues, we're back to 85% of where we were. Our cost base, is increasing. So it's 416,000, and our EBITDA is 34,000, and it's 8%. So if we're looking at, a cost increase, of 10% coming through that we're absorbing, within the business, even at the lower levels, our profits are halving from 16% down to 8%. For a larger business that was doing a turnover of 1 million with a cost base of 600,000, EBITDA of 400,000, its EBITDA percentage was 40%. So again, that business is recovering to 85 or 90%, so it's 900,000 post-COVID, but its cost base is up by 10%. Well, what impact will that have? It'll have a lower impact, so its EBITDA percentage falls from 40% to 34%. So it's less of an impact on a business, that has a lower cost base or a higher profit margin. But as we saw earlier on, the majority of attractions have probably lower turnovers, higher cost bases, and therefore, the impact of costs on their profit and on their cash flow is very significant, especially if they can't find savings elsewhere in terms of the cost base, or can pass on some of the higher costs to their customers.
Okay, there's a lot there. So I think it's both revenues and costs. Like, so it is trying to increase those revenues, but also like managing the costs. So let's take a scenario here where we have an attraction. And what we're going to do is look at the P&L, look at the impact of the last 2 years on the balance sheet, and then its costs and its cash flow. So here we have a phantom, let's say, or Crowe Museum. It's a regional Ireland location. This is a well-performing visitor attraction. It has revenue in the range of 400 to 600,000 per year. It does have some facilities that require upgrading, but similar to many visitor attractions, it has a high level of overheads and payroll costs. So let's look at the P&L for this attraction. What does it tell us? We have 2019, 2021, and then forecasts for 2022.
Yeah, I think if we look at 2019 to see how this business was performing pre-COVID, and this was a good business pre-COVID, the most of its revenues were coming in from admissions. It had a fixed, I suppose, exhibition kind of space, and therefore a lot of those admissions were flowing through to the profit line. It was doing a small amount of food and beverage, a small amount of events, and a small amount of retail. So in total, its revenue was 560,000. Its cost of sales were mainly around food and beverage, events, and retail. They came in at 38%, 42,000. Therefore, it had a gross margin of over 90%, 518,000. Its main costs, I suppose, are overheads, payroll being 39%, and general overheads being 28%. So it was making a very healthy 143,000 and 26%. I suppose during COVID and last year, it started to reopen and try and recover in a difficult market. And what we can see is that it managed to achieve revenues of 310,000. It held, I suppose, its margin at around 90%, slight inefficiency because turnover was down. But the big, I suppose, change for the business was the payroll costs. They were down to 90,000 euros because it could avail of employment wage supports in the year. Its overheads are down, I suppose, slightly because they generally tend to be fixed or semi-fixed, and so would recur once the business was open. And therefore, I suppose they're coming in at 39%. So we made 65,000 euros in 2021 at a profit of 21%. So roll forward to our budget for 2022. There's an ability, or there's an appreciation. Look, our costs are higher, and therefore our ticket prices need to be higher. And 16 euros in terms of the budget is felt to look achievable as an average ticket price for the year. So our revenues are returning at about 85–90% of 2019 levels. Our cost of sales are similar to 2019 levels. But the numbers I suppose we have to focus on here would be the payroll costs and the overheads. So payroll costs are up significantly. So there were 220,000, 39% in 2019. For the same business, and we're fully open, they're now costing 225,000 on a lower turnover, and that's 46% of our revenues. Our overheads are coming in at the same level they were in 2019, even though we're probably less busy, within the business. And we can see that, profit, I suppose, rather than returning 243,000, comes in at 74,000 per the budget, and our profit margin is 15%. And the challenge here is, there's a requirement for a certain level of profit within the business. We have to reinvest. There's a difference between profit and cash flow, which we will look at later on. But at 74,000 euros, it leaves cash flow within the business very tight, and we need to find ways to get back towards the 143,000, whether that's reducing, I suppose, our overheads, whether it's increasing revenues through, I suppose, higher volumes or higher prices, or selling maybe in a different way.
Okay, thanks. And I think as well, something I see that's highlighted is The overheads, they're not changing, that the percentage is changing because obviously the revenue is down, but the level of overheads here, this business has obviously been able to manage some of the overheads during COVID, but there is a potential that these will start to creep up. So let's just look at some of those business costs, I suppose, for a visitor attraction. Obviously their cost of sales, you know, if they have retail or food and beverage, you know, what is that? Are they tracking that? Like, I think that's really important. Are they measuring those KPIs? You know, what costs are they seeing change? Can they look at their menus? Can they look at their retail offering? Payroll costs is, again, no different to the other sectors in the hospitality industry. This is the challenging area for visitor attractions. You know, what can they do, I suppose, to manage that or to reduce their payroll cost? You know, an option might be to look at their opening hours. You know, if they always opened at 9 a.m., but they've no visitors until 9:30, can they change that to 9:30? You know, it's a small change, but you know, it accumulates to an improvement in payroll. And then do they categorize their costs, I suppose, as well, so that they can track them? You know, their admin in general, what's in that? Their sales and marketing, do they know what they're getting out of their sales and marketing spend? Repairs and maintenance and utilities. And maybe seeing the difference as well between what's repairs and maintenance versus capital expenditure. You know, it's still a cost to the business, but knowing where to invest, I think is what you've said as well, and what I'm hearing. And sales and marketing as well, like, are they spending that money correctly? Are they getting the return on their sales and marketing spend? So, you know, I think they're the ways that maybe visitor attractions can really look at their business to try and reduce some of those costs, which in turn, what you're saying, will improve their margin. So let's look at the balance sheet, I suppose, and how that has been impacted from COVID and what's happened to this business. Obviously, it's fictitious, but here's an example of 2019 versus 2022.
Yes, so on the balance sheet, we have our premises and our equipment. We built a bank loan in terms of for 375,000 euros secured against that. And in 2019, we would have had current assets of cash of 35,000, stock of 5,000, and debtors of 42,000. And our tax liabilities would have been 30,000, trade creditors 55,000. So a relatively, I suppose, simple balance sheet with net assets of 90,000 euros. 2021 would have been, I suppose, a year of recovery. 2020 would have been a more challenging year for the business, and in 2020, the business would have brought in some short-term loans of 60,000 euros, which we can see on the balance sheet. And once the government allowed taxes to be warehoused, they've warehoused some of their taxes, and therefore it's gone from 30,000 to 70,000. They also, in 2021, when there was an opportunity, decided to reinvest because they had some cash in the business, and so the asset has gone from 468,000 up to 528,000. And coming into 2022, the bank balance has gone from 35,000 up to 79,000 euros. So in terms of the business itself, it seems to have a good, strong cash position at 79,000 euros, but its other creditors and tax liabilities have gone up. And therefore, I suppose there's a risk here that there's comfort in looking at the bank balance, but it's very important that we forecast that out over 2 years to see how that might be impacted in terms of flows of money through the business.
So let's look at that then. So, like, how they're going to manage their cash flow.
So what we're looking at here is the EBITDA, and I suppose the challenge, what we're saying is we need to grow the EBITDA from 74 back up to 140,000, which it was in 2019. But if we're only growing EBITDA at 3 or 4% per year, well, then we've less money coming into the business. So, and again, we've distinguished between, I suppose, profit and cash flow. So in this business, we invest 3-4% per annum in terms of back into the asset. That's costing 19,700. We've to service our loan interest and our loan capital. That's costing 15,000 and 30,000. So we can see that the profit figure of 74,000 is only giving us 9,300 in terms of additional cash movement in the year. We add that to our opening cash, but our short-term loans need to be repaid over the next 2 years, so that's 30,000 out, and our warehouse taxes need to be repaid from May of next year, and we're looking at that over a 2-year period. So when we forecast out, what we can see is our comfortable position of 79,000 euros falls to 11,000 euros in the bank account, which is quite tight for a business of this nature. And therefore, I suppose, so that puts the focus back on the need to be able to grow the EBITDA number, quickly over the next 2 or 3 years. And therefore, we need to look at our cost base as to how we can reduce that, and revenues, how we can increase that. So really managing the profit and loss account.
Okay, thanks, Aidan. And I think you're right. Like that EBITDA that we're showing there, it's really not increasing back to the pre-COVID level. But 78,000, maybe it's a little conservative, but I think, or maybe worst case scenario, but it does take into consideration the real practical challenges, I suppose, of the sector at the moment. So moving forward, I suppose, let's talk about managing our cash flow. Obviously, it's about revenue, increases in revenues and decreases in costs to manage that profit level. And I think what you're saying is that, from a revenue perspective, you see that there is ability for the visitor attraction sector to maybe increase revenues through ticket admission prices, like you've increased, you see that price is going up, and maybe that's through ways of yield management and dynamic pricing, really looking at your peak demand times. Are you maximizing your price? Learn from the hotel industry. Are you maximizing your price during those peak demand times? If you're offering discounts for students during a peak demand time, can you stop doing that and maybe offer them alternative low demand time? So you're really maximizing the price of your ticket and the yield that you're getting in your ticket. And that's, particularly if you're saying that the demand is not going to be there yet, you want to maximize that revenue. But costs, I suppose, is another area. And suppose if we look at the increasing costs, this is the challenge, Aidan, I think. What do you think, for the sector going forward?
And we've called this out, I suppose, earlier on in terms of wages. What we're seeing, I suppose, is that they're probably 15% up on 2019 levels. And I suppose the question is, well, are our admission prices, are our revenues going to be up by as much as that to be able to recover those higher costs coming through? And there'll probably be more increases as cost of living increase over the next year or two. We mentioned earlier energy prices increasing 20-30% per annum between 2021 and 2022. Certainly they're increasing at a much faster rate than our pricing will increase. And again, insurance premiums are seeing very significant increases. So we have a number of costs here that are rising much faster than, I suppose, prices or revenues are rising. And therefore, we have to look at ways that we can reduce, I suppose, the consumption of, let's say, items within, I suppose, the energy cost bracket, and ways, I suppose, we can manage, I suppose, the claims or the amount of claims for insurance, so that, I suppose, we have a better record or history and try and hold, I suppose, current premium or try and reduce it over time.
Okay, thanks. And so let's, I suppose, maybe take it another step and say, what suggestions would you have for the sector or for the industry of ways to reduce costs and maybe to look towards recovering that profitability level on their P&L account?
So I think the first thing really is we need to know what's being consumed, I suppose, within the business. So do we know everything, I suppose, that's being bought by the business, and do we know, I suppose, the drivers of those costs? And by, I suppose, re-looking at, I suppose, what we're paying for and what's the drivers of those costs, can we eliminate some of that? Can we substitute it with something maybe that might be cheaper? Or can we do things, I suppose, in a different way? So a real focus, I suppose, on costs would be very important. A lot of our costs, I suppose, are overheads within, I suppose, the attractions sector, but we have to very much look at, what's the quantity of items being consumed, and see, you know, what can we reduce on that.
Okay. And then what about, you know, price points, I suppose, average spend up and keeping our customers, like we talked about that just earlier. You think that there is an option to increase the average yield, the average spend, maybe in our outlets, in our retail? Like, how can visitor attractions do that?
So I think, you know, in terms of the pricing model, I suppose needs to look at, you know, perhaps we were able to offer, I suppose, different packages, but probably maybe add extras maybe in to some of what we're offering, and therefore move the overall price point up. Maybe we can relook at the retail, I suppose, within some of the attractions, and see, you know, can that space perhaps be, you know, reinvigorated? Should it be licensed out? You know, what's the payroll cost of having that space open? And do we change, I suppose, something in and around that space? And equally, I suppose, with the food and beverage side of the business.
Okay. Then also finding new sources of revenue and growth. Like, is this possible really for a visitor attractions? What, like, can they do to get new types of revenue?
So I suppose, you know, in terms of, you know, in terms of, I suppose, what we saw would be, I suppose, the domestic, I suppose, market, domestic trips, you know, are rebounding, I suppose, quickly. So I think there are probably more opportunities in terms of, you know, I suppose, corporate team building, and maybe tailoring some packages towards, I suppose, group events that add to, I suppose, the normal throughput of kind of leisure visitors coming through the attractions.
Okay, thank you. And then reinvesting. I think this is a key thing, and I suppose it's again, I think we'd mentioned it earlier, the difference between repairs and maintenance and investment, like capital expenditure spend. What are your thoughts on this?
I think in times where, I suppose, our profits are lower and we have less, I suppose, to reinvest, we really need to look at, I suppose, the return on the investment. And therefore, you know, the return, I suppose, being what cost savings there might be over the next 2 to 3 years. So with energy prices being high and staying high for the medium term, I think projects in and around reducing our energy costs would be very important.
So are you talking about like solar panels, that type of thing, or even, you know, is there something more simple like our visitor attractions, like have they changed to LED lights? That's the type of thing that you're talking about?
All of those will bring, I suppose, yeah, considerable savings in terms of ongoing energy costs, and we'll have a very quick, I suppose, payback. I think what's important, I suppose, is that we're capturing data on what we are using in terms of energy. So across our facility, we need to know, you know, on a daily basis, what departments are using what amounts of energy, and therefore, I suppose, having that information, we can look to see, well, how can we do things differently so that we're consuming less energy.
I think that's a great point, actually, Aidan, and maybe you know, not all visitor attractions, I certainly see this when I work with some visitor attractions, is tracking their data. Like, not everybody tracks their data. So really knowing what are your KPIs, you know, what are your costs as a percentage basis. Sometimes we look at the numbers, but looking at it in different spend, you know, what's the cost per customer. I think that's a really good suggestion, actually, and one that's doable completely for every visitor attraction. So what's next, Aidan? Like, what are our key actions for a visitor attraction going forward? You're saying preserve margin, but understand the value. So I think that's a key point, and know what the value is, not just of your revenue, like of what it is to the customer, but of your cost. That's what you've said to us. Understand like what you're getting out of each of the costs in the business. Your cost management will be ongoing. And this is really important, I suppose. We just assume that we do it, but really do it, looking into every cost. Project out and forecast continually. So you will have a budget set potentially, and maybe it'll be based on 2019 figures, but really look forward, continually forecast, because the costs are changing in real time. And I think the business needs to stay on top of that. So it's looking out what the end of the year will look like and what their profit levels could be. Passing costs on where appropriate. Do you think this is possible, Aidan? Do you think that businesses will be able to pass on all of the costs?
Yeah, I think there's an expectation in the marketplace that if businesses have higher costs, that the ticket prices and admission costs will be higher at attractions. So I think being transparent and upfront about that is important. But equally, I suppose if you're bringing in a new, pricing regime, what we don't want to do is kind of, fire or lose our older customers, and therefore finding ways whereby we can obviously keep maybe a new pricing model and an older pricing model or some sort of a loyalty model for existing customers in place. So I think being smart about that would mean that we hold on to more of our customers.
Okay, and you had suggested this, appointing a spending controller, and I said to you, is this not the financial controller that does this? But you have a different spin on it, which I think is valuable to any business, actually.
Yeah, I think what you're going to see is most businesses think that their cost base is pretty tight. When we're looking at a cost base, here we're looking at a business that it might be doing 15% EBITDA. It means its cost base is 85%. So 85 cents out of every euro which comes into the business is going out in costs. So in order to have a fresh look at costs, I think you need a fresh pair of eyes to review the costs. So I would appoint somebody other than the financial controller, somebody senior in the business, and give them the task to say, well, look again at everything that we're spending and come up with ways to see how can we reduce, the amount of items that we're consuming in the business. How can we do things in a different way? And if there are, initiatives that we're doing or items that we're doing which are just not efficient, do we look to discontinue them?
Okay, and actually, to back onto that as well. Ask the staff. They're the eyes and ears of the business. On a day-to-day basis, they see things that management don't always see or that the owners don't always see. So I think to on that point, have somebody different look. I think you're right, Aidan. Like when you think about it like that, every 85 cents on every euro, I'm sure a business could take a couple of cents off, which would have an impact. And then finally, draft a cost mitigation action plan. What are your thoughts on this?
I think when we're sitting down with businesses and we're doing cost reviews, the one thing we insist on is that the initiative is actually committed to writing. So we have to have, a cost mitigation plan in writing that somebody takes ownership of. And within that, we're creating, trackable data in real time on how we're incurring costs in the business. And I think once we have that trackable data and we understand how these costs are impacting on our profit and loss account, what we'll find is, more ideas will come forward and we'll find ways to consume less within the business. And if we're consuming less and holding revenues, well then we're certainly on the road back to improving, our margin and our profitability.
Okay, thank you. So I suppose, Aidan, if you like 1 or 2 points to finish up this, would you say what are the key points for you for a visitor attraction to do immediately, to help to rebuild that profit level? What is that for you?
I think analyze all of your costs in as much detail as possible and take a fresh look as to how can we reduce the quantum of items that we're consuming in the business. Then maybe look at when did we last tender those costs out? When did we last benchmark those costs against another similar attraction? Is there a buying group that we could join with that might help us reduce some of those costs? I'd also then, put a specific focus on labour costs, because labour costs, in terms of shortages and the cost of labour it is going to hold back what we can achieve in the business over the next year or two, and therefore I think we've got to figure out how we can run the business with a lower labor input. So that could be automation, or that could be outsourcing. Maybe in the restaurant space, it might be buying in more prep food and having a lower kitchen cost.
Okay, that's great. Well, look, I think that's a lot of very good practical information. So thank you, Aidan.
Thanks, Aidan and Maria. And just to finish up, I'd just like to thank everybody for listening today. Just to let you know, our next webinar will be taking place in the autumn, where we will delve into more issues and topics that are facing you at that time. Thanks a million to Crowe and Aidan and Maria for a really informative session and all of those practical hints and tips and really great advice for businesses. And lastly, from myself, please keep an eye on our Business Supports Hub, which is constantly being updated, as well as our national schedule of supports, where you will find all of your training needs. Looking forward to seeing you next time. Thank you.